In Investing 101 today, we're talking about a strategy that can bring big profits or big tears. Joining me now is Dave Bartiosiak of Zacks.com. Always a pleasure.
Always good to be here.
So the strategy is short selling, and we talked about the shorts earlier in the show, and a trader noted that the shorts are becoming exhausted, and that's because these are people who want the market to go down.
That's right. So when you go short, you're doing exactly that. You are hoping that the market is going to go down. So one common strategy that people like to use is selling short when you're talking about individual equity positions. Now this works a little differently from when you go long a stock or when you buy a stock, because when you're selling short, you have to borrow those shares from somebody technically. So I have to go out and find somebody who's already long these shares, and I have to go, let me hold these down for a little bit. I'll sell them, and I promise I'll give them back to you. So that's where the risk is, because I go ahead and I sell them today, and let's say the stock's at $100, right? And then a few days from now, the stock goes up to 120. I still owe that person those 100 shares, even though it went up to $120. So I'm going to have to cover all of that move.
You have to make up that extra $20 on each one of those shares. So how does this come into play when you actually make money?
Okay, so the way that you make money is in the opposite. So let's say I go ahead and I borrow these shares of XYZ Corp, right, for $100, I go ahead and sell them. And then a few weeks from now, instead of trading at $100, the stock's all the way down at $50. Well, now I have to give that person back their 100 shares. So I got to go out and I got to buy those 100 shares, but instead of costing me a bunch of money, it's only going to cost me $50 this time around. So I'm going to pocket that difference between the $100 that I sold them at and the $50 that I bought them back at. So there's still that buy low, sell high situation going on. We're just doing it in the opposite order.
And is it available to anybody, or do you have to have a special brokerage account for this?
So it is, but you're going to have a margin account in your brokerage. So most people, if you have above a certain amount of money, it's really only like $2,000 in a lot of places, they'll approve you to have a margin account. And the reason that you have to do that is because of the requirements you have to have in your account in order to sell. So if you have a $100 stock that you want to go short, at least half of that you have to be able to cover. So 100 shares at $100, so you're talking $10,000, you have to have half of that. So you have to have $5,000 in that account ready to go.
And they can call you on those margins, correct?
They can, and when they call you, it's time to pay the piper. So you don't want to get in a situation where all of a sudden you owe on this account because it's gone against you. So that's where the risk is involved, and that's why the kind of average investor doesn't really do this all that often. But the big dogs do it. So if they're doing it, maybe you want to learn a little bit more about it.
Okay, thank you very much for coming on the show, Dave.
Thanks for having me.